Happy New Year, and welcome to Vision Capital's first quarter 2026 investment outlook. I'm Jeff Schmidt, Director of Investments. Stock markets were strong across the world in the fourth quarter as American large caps rose 2.7% to cap off a nearly 18% return for the year. International stocks were the biggest gainers, led by Korea at 23% for the quarter, followed by Japan and Taiwan, both posting double-digit returns. Most markets posted greater than 5% returns, with China being the worst with a 2.7% return for the quarter. Like 2024, optimism for large financial returns for AI innovator companies drove markets in 2025. Most of those gains occurred between the middle of spring and middle of fall as infrastructure spending announcements were one-upped month after month. We estimate that nearly two-thirds of the S&P 500 gains were AI-related, with the median return of AI beneficiaries up 23% versus 5% for non-AI beneficiaries. NVIDIA became the first $5 trillion company, and 4 companies are now worth more than $3 trillion, with 2 worth more than $4 trillion. Summed up, the market value of those 4 are equal to 52% of annual nominal GDP in the U.S. Such developments have naturally led to a growing discourse about an AI bubble. A famous investor once characterized bubbles as excellent fundamentals, euphorically extrapolated. 5 technology and industrial bubbles occurred during the 20th century, and we can scale each them to nominal GDP. In the largest and most recent bubble, the broadband and dot-com bubble of the 1990s, capital spending grew to well over 1% of GDP. In 2025, AI-related CapEx surpassed that peak, nearly reaching 1.5%. Planned data center expenditures are expected to reach $1.4 trillion in 2030, worth 3.5% of GDP. While we can't predict if new revenue streams will be sufficient to earn an economic return on investment, we can predict that such revenue streams will need to be exceptionally large. Furthermore, new revenue must not be slow to materialize like it was in the 1990s. We also can't predict which businesses will achieve a durable benefit. In the dot-com era, first movers such as AOL, WorldCom, and Nokia were not the ultimate winners. Companies that developed new business models after the infrastructure investment occurred, such as Google, Apple, and Facebook, were the ultimate winners. An elevated price-to-earnings ratio indicates that stocks anticipate strong corporate profit growth in the near and intermediate term. The ratio on the S&P 500 index is not at dot-com era levels, but it isn't far off. Complicating matters is the lack of comparability between now and then. Before venture capital markets became institutional, most companies raised capital by going public. That allowed all major companies to be publicly traded. Today, many very large innovator companies remain private. If we include them in the index at their private market values, today's S&P 500 would be like 1999. Ongoing Fed rate cuts and tax cut stimulus will support the economy in 2026 and beyond. The primary risk for stocks is the cooling of euphoric AI sentiment. We have recently taken steps to reduce AI risk in stock portfolios by shifting money to non-AI related businesses. While fixed income returns were strong in 2025, we remain concerned about higher long-term interest rates due to future budget deficits. Our investments are concentrated in near and intermediate term interest rates, and despite a 64% surge in gold in 2025, we have not taken profits. Questions about central bank policy moving forward should support gold value. Thank you for watching, and we look forward to speaking with you again in April.